This is a strange time because we have almost 3 million American homeowners who are not paying their mortgages right now, and we have more than 10 million Americans who are out of a job and still collecting unemployment checks, and we have home prices that just keep going up. So the mortgage market is in a very unique situation right now. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Let's jump right into the important stuff for today's video. I cut my finger with a pair of scissors, which is why I have a band-aid on. That way I don't keep scratching my finger every time I put my hand in my pocket. Now with that out of the way, let's talk about the mortgage market. Mortgage rates are at all-time lows, which is pushing up the demand to buy a home because so many people want to take advantage of these low interest rates, and this is pushing home prices higher, even though some people might not necessarily be able to afford the homes that they're buying. Owning a home is part of the American dream, and it's nice to be able to say that you're a homeowner, but it's even nicer to own a home that you can afford. If you have a ton of people that own homes that they can't afford, well, that's how you get a repeat of 2008. Before the 2020 pandemic, you had just under 65% of Americans as homeowners. Then in late 2020, after the pandemic hit and after interest rates were cut, you saw the number of homeowners shoot up to right around 68%. We haven't seen this high of homeownership in America since 2008. Now, generally speaking, when you see a rise in home ownership, that's usually due to a few factors. It's usually due to things like more people having jobs and wages increasing and interest rates. But going into 2020, we have to understand what is causing this increase in home ownership. Is it an increase in jobs? Well, no, that can't be it, because we have more than 10 million Americans that are out of a job collecting unemployment benefits. If it's not more jobs, then maybe wages went up, so people have more money to spend and they want to use their newfound cash to buy a home. And yeah, that might be the case for some industries like tech, because when this pandemic happened and the lockdowns hit, people were forced to stay at home and they just went on the laptop. So they went on to things like Facebook and Twitter and Snapchat, and they bought everything off of Amazon. So yeah, the tech industry boomed, but every other industry kind of didn't. But the rest of America struggled. We saw lots of Americans actually get their wages slashed, and lots of bonuses were canceled, and lots of Americans who expected to get raises actually didn't get the raise they expected because their companies weren't making as much money as they were before. If this jump in home ownership is not because of more jobs being available, and it's not because of higher wages out there, then either people got tired of watching Netflix reruns at homes and they're saying, honey, let's go buy a new home to watch Netflix in, or they want to take advantage of low interest rates and this cheap debt. The mortgage market is just in a crazy place because people can go out and get a 30-year mortgage and pay something like 2.5% on this money for the next 30 years. So you can go out and borrow $500,000 and pay less than $2,000 a month for the next 30 years to have $500,000 today. Naturally, what happens is when money is so cheap, people go out and they borrow it because money is cheap to borrow. Interest rates are low. And so collectively, these 68% of Americans who are homeowners own something like $11 trillion worth of mortgage debt in America alone. Now, this $11 trillion worth of debt, while it's a lot of money, isn't really a problem because debt isn't a problem until it becomes a problem. Like, let's say we compare two different people. Person one who has $10,000 worth of debt and person two who has $100,000 worth of debt, and I asked you who's worse off. Well, the answer is really it depends, because if person one who only has $10,000 worth of debt cannot make their monthly payments, then person one is in a worse place, because if person two can make their monthly payments no problem, then the person with less debt is actually in a worse off place because they're struggling to make their payments. So debt is not a problem until it becomes a problem, because if you cannot make your payments, that's when debt becomes a problem. So when it comes to the mortgage market, the problem is not the fact that there is $11 trillion worth of debt outstanding. The problem is the fact that 5.83% of homeowners are not paying their interest on their debt. That's something like $683 billion worth of outstanding debt that nobody is paying interest on. And so banks and agencies who are supposed to be collecting these interest payments are not getting their interest payments because you have almost 6% of homeowners that are not making their mortgage payments on this $683 billion. This is where things get even more interesting, because the fact that $683 billion worth of loans are not being paid on is still not an issue yet because of the mortgage forbearance program created by the United States government. This program was created after the pandemic as a way to help struggling homeowners, and what it says is that if you have a government-sponsored or a government-owned mortgage, so if you have a VA mortgage, an FHA mortgage, a USDA mortgage, then you can elect to put your mortgage on hold for 180 days and not make any mortgage payments. And if at the end of 180 days you still have a hardship or you still don't want to pay your mortgage yet, then you can extend your mortgage forbearance for another 180 days. This is where things get even more interesting, because you don't have to show any financial hardship to put your mortgage on forbearance. You just have to say that you want to put your mortgage on hold. If you do not have a government-backed mortgage, then you don't qualify for this mortgage forbearance program. You have to work directly with your lender to see if you can get some sort of relief or some forbearance. So it's a lot harder to get that, but the government is giving you pretty much forbearance for whatever you want. If you have a private mortgage, so your mortgage is not backed by the United States government, then you don't qualify for this forbearance program. That means you have to work directly with your lender to see if you can get some relief on your mortgage, which is much harder than just telling the government, hey, I want to put my mortgage on hold for a little while. The issue here is when you're in forbearance, your payments don't get erased. You still have to make all of your back payments and all of your back interest and all of your future payments. And the interest on your mortgage continues to accrue even if you're not paying your mortgage. So during this 180 days or 180 days plus 180 days, depending on how long you forbear your mortgage, your interest on your mortgage is still accruing, but you're just not paying any interest off because you're not making any monthly payments. I don't know this for sure, but I have a feeling that there's a lot of people that are in forbearance right now, not because they have a financial hardship, but because they just want to get a break on their mortgage. Maybe you're using this as an opportunity to build your savings, maybe you're investing your money, or maybe you're just building a fund that you can use to go on a vacation. I don't know. In any case, you're not paying your mortgage right now, but the interest is still racking up. And now when the forbearance program ends, you're going to have 3 ways to repay. Either you're going to have to pay a lump sum for all of your back payments, or you're going to have to come up with a repayment plan in addition to your monthly mortgage, or what I think a lot of people are going to do is they're going to take all these back payments and they're just going to tack it on to the back of their mortgage. So now your mortgage just got extended by another year or 2. We might also see potentially a big refinancing boom towards the end of this mortgage forbearance program, because lots of people are going to say, ooh, why do I want to stay on this higher interest rate mortgage that now is going to extend even longer because of this forbearance program, when I can just refinance my mortgage, because you can refinance your mortgage when you're in forbearance, and go to a lower interest rate mortgage because interest rates are so cheap right now. If you are banking on the idea of refinancing your mortgage towards the end of this forbearance plan, just understand that you need a few factors to be working in your favor to really do it the right way. You need 1, home prices to continue to rise, because that's going to show you have more equity in your home. That way you can get a proper refinance. And second, you want to hope the interest rates continue to stay low. As of now, it looks like interest rates are going to stay low for a long time, but that's just something to keep in mind. By the way, if you are interested in learning more about how you can refinance your mortgage the right way and save the most money, I already made a video where I talked about that, and I'll link it for you below. The issue with this mortgage dilemma is what happens if the forbearance program ends and we still have millions of Americans who are homeowners that do not have the means to pay their mortgages. Then what? Every banker on Wall Street is freaking out about this because there's just so much uncertainty. Like, what we know for sure is that there's more than 10 million Americans out of a job right now. What we don't know is how many of these Americans will continue to be jobless once this pandemic ends and once the forbearance program ends. What we know for sure is that there are millions of Americans in forbearance right now. What we don't know for sure is how many of these Americans are in forbearance because they're having a financial hardship, and how many of these Americans are in forbearance just because they want to be. And what we know for sure is that this mortgage forbearance program is giving Americans some temporary relief on their mortgages, but what we don't know for sure is if this forbearance program is going to be extended beyond what it is right now. The reason why these things are a concern are pretty obvious. I mean, if this forbearance program ends and you have millions of Americans out of a job and not able to pay the mortgages, well, now you're going to have a foreclosure crisis, and now you're going to see a housing market crisis. Nobody wants that. On the flip side, the second issue is we have millions of Americans not paying their mortgages, which is billions of dollars worth of debt that is not being paid back right now. And that cost of this debt interest not being paid right now has to be absorbed by somebody somewhere. Think of it this way. Let's say I buy a home and I take a mortgage out on this home and I rent it out to you. Now you start living in my home and you pay me $1,000 a month and I use your rental income to pay off my mortgage, to pay my property taxes, to pay for insurance and all of that. Well, what if the government says that you don't have to pay me rent anymore? Now you might get a few months of not paying any rent, but also I'm not making any money. And so I'm gonna have to pay out of my pocket to continue paying my mortgage. I'm gonna have to pay out of my pocket to pay my insurance and my property taxes. And after a while, I might not have the funds to continue making these payments. Well, in this situation where you have almost $700 billion worth of mortgages that people are not paying back, you have billions in dollars of interest that are not being paid to government-sponsored entities. And so if these government-sponsored entities are not receiving enough money, they're going to turn to the government because they're sponsored by the government. And where does the government get their money? Well, no one other than you, taxpayers, through tax dollars. So if these government-sponsored entities are losing money because they're not getting any interest this year and they get squeezed for cash, they're going to turn to the United States government, and the United States government is going to turn to you for extra tax dollars. So there's a couple issues at play here. The first issue is obviously the housing market. If people do not have the means to pay their mortgages, that causes a housing market concern. And on the flip side, it's more of a government issue because if people are not paying their mortgages, that cost has to be absorbed somewhere, and if it's absorbed by the government, that means the cost is absorbed by you, taxpayers. The thing that you want to pay attention to now and into the future is, are we inflating the problem with this forbearance program? Like, if there is a housing bubble, keyword if, you want that bubble to burst as fast as possible because the bigger the bubble gets, the bigger the explosion is going to be. Think of it like blowing a balloon. If you're blowing a balloon and it pops while the balloon is small, it's not going to make that big of an explosion. But if you get one of those big 36-inch balloons and you're blowing it and you're blowing it and you're blowing it and it gets huge and then it pops, so that's going to make a much bigger explosion because it is inflated with a lot of air. Again, I don't really know if we're set up for a housing market crash, but if we are, then a forbearance program that just lets people delay the problems just makes the problem bigger. The thing that you have to ask yourself is, what precedent is this setting? Because if we have a recession in the future, or I should actually say when we have a recession in the future, because I can guarantee we're going to see a recession in the future because that's how economies work. You have booms and you have busts. So when we have a recession in the future, what is the government going to do? Are we going to create a forbearance program? And if that happens when we're in a recession in the future where we're actually in a potential housing bubble, so now in the future when you have a bubble bursting, it could be a whole lot bigger. Now I get it, 2020 was an anomaly and nobody expected a pandemic to come out of nowhere, but you have to think about these things in the future. But going back to the now, the reason why you want to pay attention to what's happening in the mortgage market and the housing market is because right now there are about 2.7 million homeowners in America that are not paying their mortgages. If you look back at 2008, which was the worst real estate crash in modern history, there were something like 3.1 million homeowners who received a foreclosure notice because you had 3 million Americans, 3.1 million Americans that were not making their mortgage payments. So we're not too far off now than we were in 2008, but the thing that makes right now interesting is I can pretty much guarantee you that when the forbearance program ends, a chunk of these people are going to start paying their mortgages again. But we just don't know how many of these people. And we also don't know how many more people are going to not be able to pay their mortgages when we find out the pandemic is done and people stop receiving unemployment benefits. There's 3 things that I need you to do. First, I need you to pay attention to the interest rate market, because if interest rates keep going down and mortgage rates keep going down, then you're going to see the demand to buy a home keep going up, which is going to push home prices even higher. But if interest rates start to go up, then you're going to see mortgage rates go up, and we could see a shift in the housing market, because if it's more expensive to go out and borrow money, then people will be less likely to go out and buy a home. The second thing I need you to pay attention to is the economy and the job market, because we have a ton of uncertainty ahead. If once this pandemic goes away and the government programs go away, the economy continues to roar and be strong, then we can see jobs come back. And if jobs come back, people will have an income stream. And if they have an income stream, then they will be able to pay their mortgages, and we could see the economy continue to roar. But if the economy stays slow, or we see more business closures or more permanent job losses, then we could see an issue in the housing market because people will not have an income to pay their mortgages. And third, I need you to take care of your personal finances, because the reality is we have a lot of uncertainty ahead. Nobody can predict what's going to happen in the economy or the stock market or the job market in the future. Everybody has a prediction, but nobody knows for sure. And so you need to use this as an opportunity to really take care of yourself. Build a savings cushion just in case. Continue to invest your money and have some cash ready to invest into things if an opportunity comes your way, because there's a chance that we could see big investment opportunities come as this pandemic starts to go away and as we start to really see the test of how strong our economy is. If you enjoyed this video, here's a video that I think you'll love, and while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. For one, I am very confused, and for two, if you're telling me that I'm gonna pay the same amount of money at the end of the day, what the heck is the point of me refinancing? Well, this is where understanding money really comes into place, because